Hi, and welcome to my monthly market insights video. My name is Dan Timotich. I'm one of the founding principals and portfolio manager at T2 Asset Management. It's been a tough finish to 2018, but I want to wish everybody a happy new year. But before we get started on this video, I just want to remind you this is for educational purposes only. The opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers at T2 Asset Management. You should always consult with a financial advisor before making any investment decisions. And remember, investments involve risk and are not guaranteed. Okay, looking at the beginning of this video here, the good, the bad, and the ugly. Well, in 2018, everything looked good for the first 9 months, but in the fourth quarter and December in particular, very little was good. The only thing that seems to have really worked out well was playing defense and holding a lot of cash, which is something we did for our clients. But other than that, there was very little to shine a positive light on, with the exception of probably the fact that the big sell-off did cause stock valuations to get much more attractive at the end of the year. As far as the bad's concerned, the government shutdown, although some may argue that that's not necessarily a bad thing, but it definitely does cause some turmoil in terms of future economic data. The Fed concerns and its continued talk about further rate hikes, and probably more important than all of those is the fact that the yield curve had flattened quite a bit in the fourth quarter and December in particular. The ugly, this was the worst quarter that we've seen since 2008, and it's been the worst December since 1931. So hopefully we could go through some of the things that had happened, what we did, and make some heads and tails out of this turmoil in December in the fourth quarter. As this chart here shows, the green line is the U.S. stock market and represented by the S&P 500, and then the red line is the international stock index. As you can see, the U.S. stocks did significantly better than international stocks for the year. Right here you can see that the S&P was down about 6.2% for the year, and international stocks were down about 16%. We had a negative view on international stocks all year, and it turned out to be the right call. Given the dollar activity and how much it was strengthening throughout the year, we had a great deal of concerns given where we were in the cycle, and so we avoided international stocks for our clients, and that turned out to work out pretty well. Just wanted to touch base on and review a couple of things that we talked about in prior videos, but let's just recap what happened with this roller coaster ride in the fourth quarter. As you may remember, it all began when the Fed chairman gave a speech indicating that he was on track to raise rates not only in December but also 3 more times in 2019, and that began the first leg of the sell-off. After that, we had the elections, and the Democrats took control of the House. If you remember, we talked about the fiscal stimulus being over and that we would expect to see headwinds for economic growth in 2019 as a result of the elections. Our short-term model indicators thereafter started to show problems and started to break down a little bit, and so we began to start de-risking our client portfolios somewhere around early November, mid-November. After that, we had our long-term models began to break down even more, and so that indicated that we were expecting to see more problems in the market and more pain. So we ended up decreasing our stock exposure, and in my core equity portfolio, for example, we were holding 40% in cash on December 11th. Now, while our long-term models and our indicators were all starting to show cracks, I didn't expect it to be so quick in coming through fruition. If you could see, as you can see here, since December 11th till about Christmas Eve, we saw the stock market fell an additional 11%. And while it was great that we had such a large cash position for our clients, it was painful for really everybody. But by the time we got to Christmas Eve, it appeared that the market was at levels that we were comfortable owning stocks at, and so we began to redeploy that cash back into the stock market, which turned out great for us and for performance. And hopefully In the near term, I do think that was probably a near-term bottom in the stock market. We'll still have to see what happens here in the first quarter, but to me, the risk of further meltdown in the market was significantly less than seeing a potential rebound, because I think it was an oversold condition that we were in not only the fourth quarter, but in December in particular. So looking to bonds, they didn't do much better either. The red line here is the high yield bond market. The black line is long-term treasuries. And as you can see by this chart, it looks like bonds were down somewhere around 10% at the beginning of November. So we saw interest rates really skyrocket over the course of September, October. And if you remember my past videos, I talked about interest rates peaking somewhere around there. Since November, the long-term bonds did very, very well, and were able to stage somewhat a rebound, being down only about 1.5% or so for the year. High yield, on the other hand, was down about 3.25% or so. But much less pain in bond markets than in the stock market, but nonetheless, it was a tough year overall. Looking at the interest rate cycle, this here is a 10-year Treasury chart. If you remember, back a couple of months, I believe that interest rates had peaked about 3.25. That's when I decided to extend my bond portfolio duration. And since then, we saw interest rates drop significantly, dropping down to about 2.5% over a 2-month period. That worked out really well for our clients. Just remember, when interest rates go down, bond prices go up. So by extending the duration of the portfolio, I was able to capture some of those gains for clients. So what kind of changes did we make? As I mentioned earlier, we did build a large cash position in early December in anticipation of further market weakness. Once we hit levels in the stock market that made it attractive for us to redeploy that cash, we did go ahead and start putting that money back to work. On the bond side, as I mentioned, since rates peaked back in October, November, and I extended duration so much, I wanted to take advantage of the fall in interest rates to capture some of those gains and protect clients. So I did shorten bond duration portfolios. Also, we did add some alternative investments, things that do well when the stock market goes up, but with much less sensitivity or volatility than the stock market. So that's something that I'm probably going to be looking to do more of as we enter into the first quarter here and the second quarter of 2019. And I think most importantly, if anything, is that we followed a disciplined process. We're not trying to pick market tops or bottoms, but what we're trying to really do is have a disciplined investment process. You got to understand that successful investing requires a thorough understanding of macroeconomics, valuations, markets, etc. And you need to implement a careful process that's centered around rigorous research, analysis, and experience. What we do every day is manage risk for clients, and in order to do that, you have to have a process in place that's going to allow you to make investment decisions that are not based on emotion. So looking at the different areas that I look at, as far as the economy is concerned, we did see some weakness in manufacturing numbers. However, employment is still strong, and even though we had phenomenal second and third quarter GDP numbers, it looks like GDP expectations for growth are down a little bit. Atlanta Fed is projecting about a 2.5% fourth quarter. Nonetheless, the economy is still fine. It's growing, and so it's a neutral environment to be in. As far as earnings are concerned, we just had a terrific 2018 as far as corporate earnings are concerned. Profit margins are still strong. I do expect earnings to continue to grow into 2019, albeit not at the pace that we saw in 2018, but earnings should continue to grow, and I expect that to continue on until we see real signs of economic deterioration. As far as valuations are concerned, all the pain that we just felt in the fourth quarter, in particular in December, did make stocks very, very cheap. Forward PEs are below their historic average. If you apply a growth rate to earnings from 2018 to 2019, that valuation is even more attractive. The one area that I want to keep an eye on, though, is bond spreads. Corporate bond spreads did widen a little bit, showing signs of potential weakness, but nothing to the level that I'm really concerned about, but it's something that I definitely want to keep an eye on going forward. And as I said earlier, I believe interest rates have peaked, which makes future cash flows look much more attractive in the stock market. And then finally, the markets overall. Volatility is here to stay. We are still trying to figure out whether or not the Fed is going to walk back all of its talk about future rate hikes. My sense is that they've walked back a significant amount of that talk, and I think they have indicated, at least to me, that they're going to be much more data dependent. But nonetheless, the markets are going to hang on every word that the Fed says, and we're just going to have to pay attention to all the releases that come from the Federal Reserve. And again, I think that Christmas Eve will hopefully be the floor of the recent sell-off. We'll keep an eye on how the markets are reacting to economic data. We're about to enter earnings season, and we'll see if earnings surprises to the upside are going to drive stock prices higher. I do see limited risk to the downside at this point, but it's definitely going to be something that we need to pay attention to as we see more and more economic data in the coming months. So what can I expect in 2019? Well, I do think that the economy is going to slow, but I don't see a recession right now. As I've mentioned multiple times in previous videos, I never saw the Fed raising interest rates 3 times in 2019. I think they've done enough thus far. Some may argue that they've done too much too soon. They did unwind their balance sheet quite a bit, which has added to the removal of liquidity in the market. So we'll keep an eye on the Fed, but I'm pretty sure that the Fed is, for the most part, done raising rates at this time, or at least should pause for a period of time. If they do continue to raise interest rates, that could be a problem later on in 2019. But at this point, I'm not overly concerned about that. I do expect Washington to be very contentious this year. I mean, it's been clearly said by the Democrats in the House that they're going to have more and more investigations. They're looking to add additional regulations to banks and other financial institutions. I think it's just going to be an ugly environment. Republicans hate Democrats, Democrats hate Republicans in Congress, and so there's going to be no fiscal stimulus or nothing positive that comes out of Congress, in my opinion, that's going to be substantive enough to drive economic growth. So we're really going to have to rely on corporate America to generate the earnings in the face of virtually no fiscal stimulus going forward. I'm going to have to be a lot more active in 2019 is my expectation. We can't ignore the data. Sitting back and just watching the markets do whatever they do without doing any sort of analysis or not having any understanding of what's behind the market action is going to be a fool's errand. I think that investors are going to be very well served to be more nimble in their allocations as certain data points start to come out. And then finally, you can't react emotionally. It's never paid off for investors. I think buy and hold investors will be forced to react emotionally when it's too late, and they'll end up calling their advisor after the pain has already set in and ask them to make some changes. If you want to really have a disciplined process, now's the time to have those discussions with your advisor. Understand what kind of investment strategy you have implemented, and play through all of the what if scenarios in the event that we do see a continuation of the fourth quarter at some point here in 2019. If there are any questions that you may have on our process or just want more details on how we navigated throughout this past quarter in December, please give me a call or send me an email. I want to wish all of you wish you all well in 2019, and I hope that these videos have been helpful as you analyze and make your investment decisions. Thanks again for watching, and I'll see you next month.